The silver market illusion, how paper replaced reality for decades. The silver market looked calm on the surface. Prices moved up and down. Headlines came and went, and most investors believed silver behaved like any other commodity. But beneath that calm exterior, a completely different system was operating. One built not on physical metal, but on promises, leverage, and confidence that no one would ever ask for delivery all at once. To understand what's happening now, you first need to understand how silver trading stopped being about silver. The birth of the paper silver market. Silver used to be simple. If you wanted exposure, you bought physical bars or coins. Industrial users signed long-term supply contracts with refiners and miners. Prices reflected real supply and real demand. That changed as financialization swept through commodities. Over time, futures contracts, options, swaps, and unallocated accounts became the dominant way silver was traded. Instead of metal changing hands, contracts did. A single ounce of physical silver began supporting dozens, and eventually hundreds of paper claims. This system worked for one reason. Most participants never intended to take delivery. Banks, hedge funds, and large institutions treated silver as a trade, not a resource. Contracts were rolled over, closed out, or cash safe. Physical silver stayed mostly untouched in vaults, while paper volume exploded. By the early 2010s, the silver market was no longer a metal market. It was a derivatives market, loosely referencing metal. The role of big banks. At the center of this system sat a small group of global banks. Institutions like JPMorgan, HSBC, Deutsche Bank, and a handful of others acted as market makers. They provided liquidity, wrote contracts, and absorbed the other side of trades. When investors went long, banks often went short. This wasn't illegal by itself. In fact, it was how the system functioned. But over time, something unusual happened. Short positions grew far larger than available physical supply. The assumption was simple. Silver prices would stay manageable, volatility would be controlled, and no mass demand for delivery would ever appear. 4 years, that assumption held. JPMorgan's complicated history with silver. No discussion of silver is complete without JPMorgan. In 2020, JPMorgan paid nearly $1 billion in fines related to precious metals spoofing, placing fake orders to manipulate prices. The settlement confirmed what many traders already suspected. The silver market was not as free or transparent as advertised. After that case, many assumed JPMorgan would step back from aggressive positioning in silver. What actually happened was more complex. Public data suggested JPMorgan gradually reduced visible short exposure, but behind the scenes, the bank continued playing a central role in clearing, vaulting, and structuring silver trades. Most importantly, JPMorgan controlled one of the largest physical silver vaults in the world, particularly tied to the COMEX system in New York. That detail would become critical later, the hidden weakness. Fractional silver. Here's the uncomfortable truth about modern silver markets. There's far more paper silver than physical silver, depending on the estimate. Every ounce of deliverable silver may support anywhere from 50 to over 100 paper claims. This is not a conspiracy. It's openly acknowledged by market structure. It works as long as industrial buyers source silver quietly. Investors settle in cash trust, and the system remains intact. The moment too many participants demand physical metal simultaneously, the math breaks. And by the mid-2020s, that pressure began building. A new kind of demand, silver demand, changed fundamentally in the last decade. This wasn't driven by coin collectors or small investors. It was driven by technology. Silver became essential for solar panels, electric vehicles, power electronics, 5G infrastructure, medical devices. Unlike investors, industrial users cannot substitute silver easily. If they don't get metal, production stops. By 2024 and 2025, industrial demand quietly reached record levels. While mine supplies struggled to keep up, this created a dangerous imbalance. Paper markets assumed abundance. Physical markets experienced tightening. The two were no longer aligned. The early warning signs before prices exploded. There were signals, but they didn't appear on CNBC. Lease rates rose sharply, meaning it became expensive to borrow physical silver COMEX. Registered inventories declined, not total inventory. The deliverable portion. Retail shortages appeared. with coins selling at massive premiums. Delivery wait times increased for industrial users. These signs pointed to the same conclusion. Physical silver was becoming scarce where it mattered most. Still, prices stayed controlled. Why? Because confidence remained intact until it didn't. The trigger point no one expected, according to market analysts. The turning point came when large industrial buyers began demanding guaranteed physical delivery, not just exposure. Reports circulated of massive orders, particularly from Asia, that could not be satisfied to Soleil through normal channels. Suddenly, contracts that were assumed to be rollable weren't. Metal was being asked for, not next month, not next quarter, but now. This forced a question the paper market wasn't designed to answer. Who actually has the silver when price stops being the real problem? As silver approached and crossed the $60 level, something changed psychologically. This wasn't just another resistance line. It represented a breakdown in confidence above $60. Short positions became increasingly painful margin requirements. Rose delivery risk increased exponentially for banks holding large short exposure. The problem wasn't price, it was availability. A short seller can survive rising prices. They cannot survive delivery they can't make. And this is where JPMorgan's story begins to diverge from the rest. A quiet shift behind the curtain while many banks appeared trapped. Data suggested JPMorgan's exposure looked different. Public filings, vault movements, and ETF activity pointed toward something unusual. JPMorgan appeared to be accumulating physical silver rather than relying on paper exposure. This wasn't announced. It didn't make headlines. But metal was moving. Silver was leaving the market, not into retail hands, but into controlled institutional custody. If true, it meant one thing. Someone expected the paper system to fail and positioned accordingly. Why this matters. This story isn't about villains and heroes. It's about structure. When a market built on leverage meets real-world scarcity, the strongest players don't fight the system. They adapt before it breaks, and those who don't adapt get trapped. In the next part, we'll examine how short exposure became concentrated, why some banks couldn't exit without detonating prices, the mechanics of a modern silver squeeze, and how delivery stress cascades through the entire financial system. The short trap, how banks got caught on the wrong side of silver by the time silver moved decisively above $60. The problem facing major financial institutions was no longer theoretical. What had been a manageable imbalance quietly turned into a structural crisis. The silver market wasn't just tightening. It was exposing a fatal flaw in how risk had been distributed across the system. To understand why some banks were trapped while others escaped, we need to look at how short positions really work in modern commodity markets. How the silver short game actually works when a bank sells silver short. It's not betting that silver disappears. It's betting that price volatility remains controllable and that contracts can be rolled forward indefinitely. In normal conditions, this is safe. Most futures contracts never result in physical delivery. They're closed or rolled before expiration. As long as liquidity is high and participants are willing to settle in cash, banks can maintain massive short exposure without ever touching metal. But this strategy depends on one fragile assumption: no sudden demand for physical delivery. Once that assumption fails, the entire structure becomes unstable. Why delivery risk is the real threat. Price risk is manageable. Delivery risk is not. A bank can absorb mark-to-market losses if prices rise, especially large banks with deep capital reserves. What they cannot absorb is the obligation to deliver physical silver that simply doesn't exist in sufficient quantity. As silver demand tightened, industrial buyers started insisting on guaranteed delivery. At the same time, investors grew skeptical of unallocated accounts and paper claims. Suddenly, silver wasn't just an asset, it was a resource. And resources can't be printed. The concentration problem, one of the most dangerous aspects of the silver market, was how concentrated short exposure had become. A small number of banks held a disproportionately large share of the total short interest. This worked when coordination and confidence held. But once prices began accelerating, those positions became liabilities rather than tools. If too many shorts tried to exit at once, prices would explode. If they stayed in, margin costs would drain capital. It was a classic trap, but on a scale rarely seen. JPMorgan's strategic pivot. This is where JPMorgan's position appeared to diverge. While some banks remained heavily exposed through futures and swaps, evidence suggested JPMorgan had been quietly reducing net short exposure long before silver crossed $60. Instead of relying on paper contracts, JPMorgan appeared to shift toward physical accumulation and controlled inventory. This wasn't speculation, it was risk management. Owning physical metal transforms a bank from a price taker into a supply holder. It changes your exposure completely. If prices rise, you benefit. If delivery is demanded, you can meet obligations. If the system strains, you survive. That difference mattered. The banks that couldn't escape, not every institution, had JPMorgan's flexibility. Some banks were locked into legacy positions, long-standing short strategies that couldn't be unwound without driving prices sharply higher. Closing those positions would have meant triggering the very squeeze they hoped to avoid, so they waited. They assumed prices would retreat, demand would cool, central banks or regulators would intervene, but none of that happened. Instead, silver continued climbing, inventory kept draining, and lease rates surged, a clear signal that physical metal was scarce and highly valued. Margin calls began to bite as silver moved higher. Margin requirements increased. Short sellers had to post more collateral just to maintain positions. This wasn't about losses yet. It was about liquidity. Every dollar tied up in margin was a dollar not available elsewhere. For some institutions, this created internal stress. Capital had to be redirected. Risk committees grew uneasy. Questions that hadn't been asked in years suddenly mattered again. What happens if deliveries spike? What happens if counterparties demand metal? What happens if confidence breaks? The psychological shift in the markets don't collapse all at once. They crack first. Psychologically, as silver crossed $60, perception changed. Traders who once assumed the market was controlled began reassessing. Investors started asking about vault inventories. Industrial buyers began securing longer-term supply agreements at almost any cost. The belief that silver always comes back down no longer felt certain. And when beliefs change, behavior follows. Physical demand overwhelms paper supply. This is the point where paper markets lose dominance. Paper contracts can create exposure, but they cannot create metal. When physical demand overwhelms available supply, prices must rise until demand is rationed. This is not speculation. It's mathematics. At higher prices, some buyers drop out, substitution becomes attractive, demand destruction begins. But until that balance is restored, price discovery becomes violent. Why this squeeze is different, unlike past silver squeezes driven by speculators. This one was driven by necessity. Industrial buyers weren't chasing profits. They needed metal to function. Governments weren't trying to corner the market. They were securing supply chains. This made the squeeze far more dangerous and far more persistent. Speculators can sell. Factories cannot. The moment confidence broke. Once the market realized that not all paper claims could be honored with physical delivery, the game changed permanently. Silver wasn't just repricing. It was redefining itself. From financial asset to strategic material, from tradable contract to scarce resource. And in that environment, only those holding real metal had certainty. What this means going forward, this wasn't the end of the story. It was the beginning. The events unfolding weren't about price targets or charts. They were about the limits of financial engineering. When too many promises are written against too little reality, the system eventually reconciles the difference. And when it does, the adjustment is never gentle. In the next part, we'll explore how institutional behavior confirmed the squeeze, why inventories kept falling despite rising prices, and what history tells us happens next when confidence in paper markets collapses. When paper breaks, what happens after the silver illusion ends. By the time the silver market reached this stage, the outcome was no longer about speculation or short-term price movements. It became about systemic limits. When paper claims vastly exceed physical reality, the market eventually forces a reckoning, not through announcements or policy changes, but through scarcity. This is where the story moves beyond JPMorgan, beyond individual banks, and into the structure of the global financial system itself. The collapse of confidence in paper silver once investors and industrial buyers began questioning whether silver contracts could actually be honored with physical delivery. Confidence cracked, and confidence is the glue holding derivative markets together. Paper markets don't collapse because of price spikes. They collapse when participants stop believing the paper represents something real. As inventories continued falling despite rising prices, the message was clear. Silver wasn't flowing back into the system. It was being pulled out and held. That is the point of no return. Why rising prices didn't fix the shortage. In most commodities, higher prices bring new supply online. But silver doesn't respond that way. Most silver is mined as a byproduct of other metals, like copper, lead, and zinc. You can't simply turn on silver production without broader mining expansion. A process that takes years, not months. So even as prices surged, supply remained tight. This exposed a fatal flaw in the idea that markets always self-correct quickly. In silver's case, price cannot instantly create metal. The strategic shift toward physical ownership, as this reality set in, behavior changed. Institutions that understood the risk stopped chasing paper returns and focused on control of supply. Physical silver became less about investment and more about insurance. This is why metal didn't return to exchanges. It moved into strategic reserves. Long-term industrial contracts. Private vaults, state-controlled stockpiles. Once silver leaves the tradable market, it rarely comes back voluntarily. What history tells us happens next. History offers a clear pattern. When commodity markets transition from abundance to scarcity, pricing doesn't stabilize, it resets. Old benchmarks become irrelevant. New pricing reflects strategic value, not speculative convenience. We've seen this before with oil in the 1970s, rare earths in the 2010s, energy markets during geopolitical conflicts. Silver now sits in that same category. Not because it's rare in the earth, but because it's essential in modern systems and controlled by limited supply chains. The real lesson most people miss this story isn't about predicting exact prices. It's about understanding who holds leverage when systems strain. Those who control physical resources gain power. Those who rely on paper promises lose flexibility. JPMorgan didn't win because of foresight alone. They adapted to a system reaching its limits. Others didn't or couldn't without detonating the market. What comes after the reset? The old silver market, dominated by leverage, suppression narratives, and endless paper supply, is unlikely to return in the same form. What replaces it will be smaller, tighter, and far more sensitive to real-world demand. That doesn't mean constant price explosions. It means permanent awareness of scarcity. And once that awareness exists, markets behave differently forever. Final thought: every financial system runs on trust until trust is replaced by reality. Silver's story is a reminder that no matter how complex financial engineering becomes, it cannot override physics, supply chains, or industrial necessity. When paper and reality diverge long enough, reality always wins. And by the time most people notice, the adjustment is already over.